Welcome to Mastering the Math of Business with Lauren Young. Today I'm going to take you back to the one thing I took away from my Accounting 101 class. I took this my sophomore year of college, and the professor shared this statement with me, and it locked in, and I've had it with me ever since. And this is the number one law of business, and that is when you're out of cash, you're out of business. That is the number one law of business. Doesn't matter how big a business is, once they run out of cash, once they have insufficient cash inflows to cover their cash outflow obligations, they are a business that is going out of business. And so you see in this one visual, I put the sign up that says, "Sorry, out of business. We failed to manage our cash." Because that really is at the crux for small businesses as it relates to what causes them to run out of cash. It's a failure to manage cash. So think about cash this way. Cash is an asset that is used to pay off liabilities. In other words, the business has these financial obligations that they owe money to. They come in a variety of different ways, but the point is the cash that comes in from sales and other avenues is the cash that is used to pay off these obligations. If you're able to stay on top of that, everything goes fine. So if you have sufficient cash to pay your obligations, everything's good. It's when you start running tight on cash that you start entering into a zone that is just loaded with problems. In fact, if you're too long in paying your bills, in other words, you're overly past due, then the people you owe money to will start coming after you. That is why this is the number one law of business. When you're out of cash, you're out of business. So the way I like to think about cash is I like to think about it in terms of availability. So you've got your cash inflowing. And that cash inflows from a variety of sources, the number one source being operating cash flow, which is a function of sales collection. Then you've got this timing factor, and that timing factor is significant because you've got these cash outflow obligations. This is the money going out of the business. And in this little illustration, you have the cash inflowing in the month after the cash needs to outflow. And this is where a lot of small businesses get themselves in trouble. And it can be very stressful when you're in this space wondering what your cash availability is. In fact, take a look at this statement here. The challenge for businesses is that when their current liabilities exceed their current assets and they have no access to additional financing or investor capital, that is a business that is considered upside down because their cash outflows exceeds their cash inflows. And if that's allowed to occur too long, we're in that out of business scenario. It's unmerciful. And it really comes down to managing your cash. In fact, the asterisk associated with this cash availability question is you can get rid of the cash availability question by managing your cash and having a cash management system. Doesn't mean you always like your cash position, but at least you know what it is and you aren't surprised by it. All right, let's take a look at a scenario here. This is a business that has a pretty healthy bank balance. In other words, their current bank balance is right at $1 million. The challenge is they have a cash burn rate of nearly $1 million, and that's a monthly cash burn rate. So they're burning through $861,000 a month in cash. So that gives them, as they enter month one, that gives them a $138,000 cash cushion. So this is the scenario for a business. This is how they ended the year, and this is what they're looking to burn. So they start the year with a cash cushion of $138,000. Then you go through these scenarios: cash sales, AR collections, other income receipts, and they're expecting to have $558,000 come in month one. That's January in this case. The challenge is that only leaves them with $700,000. They're burning $861,000. They'll have a cash deficit of $163,000 if they don't slow down their burn rate. And so this is why the cash management system helps you gauge what's your burn rate and what's your availability position. So let's look at what you need to know to be able to calculate this. Well, one thing you need to know is you need to know, what are you expecting to happen? And again, we're back to the profit plan. Profit plan helps you determine what is it you're expecting. So in the upcoming year, the expectation is they'll generate $12.2 million in sales and in the year with net income of $2 million. Then you've got to take into some factors that affect your cash availability. So the first factor is your current bank balance. That's an ongoing factor. Then it's your collectible. In other words, how much AR are you collecting? And then you want to know what your cash sales percent is. In other words, how much of this sales doesn't go through AR, it's just straight cash. You want to appreciate what your other income received. And see, we're looking at month two. We know what month one is. We're coming in with $138,000 cash cushion based on our current bank balance. But we're looking to get a sense of what our month two cash availability position is going to be. And then the last thing you gotta add into this is your debt repayment by month. Because remember, the difference between your net sales and your net income, that is your direct costs, your overhead costs, and your non-operating costs. None of those have any debt repayment in it. Your non-operating costs will have your interest expense, but not your principal payments. And so these are the 5 primary factors that you need to know to be able to calculate your cash availability. So let's look at them for this business going into month 2. So this is what their scenario is looking like. And with that, we're going to get a chance now to see just how tight cash is for this business. And it's tight because they've got a pretty healthy burn rate. Their burn rate is right at $860,000. That's basically the difference between your net sales and your net income divided by 12. See, that's how you get down to that number. Then you've got to add in your debt repayment, and that's how we got to this current month burn rate. Now, they don't do a lot of cash sales, so there's not a lot of cash inflowing straight off of sales. And so here's where they're going to come in, where this is the cash remaining, this is the cash coming in, that's cash sales plus AR receipts and any other income, and then the difference between what cash they have available and their burn rate is their month 2 likely cash position without adjustments. This is the challenge that many small businesses face because they don't have these massive cash reserves that they can access and tap into. So let's look at this for a smaller business. We'll use the same percentages, but these are some pretty big numbers for most small businesses. So let's look at it for a smaller business. We're gonna keep the net income at 18%. So sales are $3 million. That puts the net income at $500,000. Then we're gonna keep these. Excuse me. Sorry about that. Then we're gonna keep the bank balance, the AR collections, and the debt repayments at a comparable percentage level relative to sales. And so here we've got the same scenario. We've just changed the sales number, and you can see that here the cash availability challenge is $34,000. So how do you deal with this? Well, the most efficient way in the near term is you got to go after your burn rate. You got to spend less. The other way is to hold the line on what you're spending and bring in more sales so you've got more cash quality. The point is you have a choice to make. You can either operate your business in the dark through what I call the hope method, hoping the money will be there when you need it, or you can adopt the cash management system that helps you do this math so that you can have a sense of where your business is going to be when you're looking 2 weeks out, 4 weeks out, and for some even 8 weeks out. The point is, cash availability is the key to protecting you from running your business out of cash. As with all videos, I do want to put a call to action before you. If you struggle with having more cash because your business is operating at good, healthy profits, then you need to take the opportunity, go to business-cpr.com/C5, and you can read a really great article on helping you realize whether you have a cash velocity or a cash quality problem. In fact, these are the illustrations that are associated with both cash velocity, cash quality, and hopefully you don't have both. It's really tricky when a business has both the cash velocity, which is the speed at which cash comes in, and the cash quality, which is the amount of cash that's left over after direct expenses are paid. Both of those combined creates periods of just unbelievable stress. As with all videos, I welcome the opportunity to engage. So offer your comments, questions, suggestions. They're always welcome. Just as likes are, as well as subscriptions. Subscriptions give you access to the latest and greatest coming out of the Business CPR Management Platform. Thanks again for tuning in. Look forward to joining you on another edition of Mastering the Math of Business.